software. Go.
Hi everyone, Lee Honish. I want to give you some helpful tips for your clients, and it's based on a file that I discovered today. Most of you right now seem to think that your short sales are a little bit tougher and that the market has changed to a certain degree. That's not really necessarily the case. You need to be aware of a couple of factors though, and certainly a file that I recently encountered when doing a conference call. First and foremost, for all of you who think that short sales have changed, I want to make it very clear, short sales have not changed. It's your perception and what your clients have done. So the very first thing you want to do when you get a new client is ask them this very first question. Have they talked to the bank about doing a loan mod, or have they submitted anything to the bank for a loan mod? Have they sat on hold and done any of the online questionnaires for a loan mod? Okay, that's first. The second question I want you to ask them is, this is the big one, when did your loan originate? And here's why. Recently I encountered a loan. It had some very unique characteristics. It was a 75-25, was with the same bank, okay, and it had PMI on the second position lien. That's the big deal here. The second position lien was also a HELOC, but it was originated September 07. That makes it post-short sale. So here's what the banks have done. They have created a loan that can be given out in the current market based on depreciation. So what you want to look for are characteristics like a split, 80-20, 70-30, 75-25, whatever it is. And that's to protect the asset in the depreciation. So if I do a loan from this point forward, I'm going to naturally assume that it's going to depreciate in value. And if I'm going to assume that your client is going to fold up and go into default, I need a way to protect the money. Let's say it's $100,000 in this case. That's what I've lent, right? So it's split into two pieces, a 75 and a 25. My 25 is protected by PMI and the fact that it's a HELOC. Why a HELOC? A HELOC is a home equity line of credit. It also carries the credit characteristics. So if you default and they don't agree to anything on that $25,000, they can still collect on the 25, even after accepting the mortgage insurance as well. So they get the deficiency and they get the mortgage insurance. That's now protected. That means that their only asset is the $75,000. And if they did their projections correctly based on the depreciation of the market, what they've built is a way to protect that equity gap. That's really important for you to understand. If you have additional questions, go ahead and visit fastshortsale.org. Go read up on it, leehonish.wordpress.com. And of course, you can always call us at Lvdm 702-478-5836. Help your clients, and I'll help you. Thanks.